Glad to know. Stay with us. South Africa's derivatives market will switch to a new interest rate benchmark, Zaronia, for short-term loans starting this year. Zaronia, based on real transactions, replaces the Johannesburg Interbank Average Rate, JIBAR, and aims to improve transparency and risk. This is part of a global shift away from benchmarks susceptible to manipulation. Full rollout to other markets follows in 2025, with JIBAR phasing out by 2026. Phelisa Nkomo, an economist from South Africa, joins me for more on this. Good morning. Thank you for joining me today.
Good morning. Good morning to your listeners as well.
All right. Well, the Reserve Bank made it clear at an April 19 conference in 2023 that it would like to switch, to Zaronia, and it would like that switch to happen as fast as possible. More than 1 year down the line, what has been the success rate of this switch so far, or even Zaronia?
I think the first issue we are probably addressed is that why has South African Reserve Bank has switched to Zaronia? Firstly, you might be aware that there is a widely published irregularities in relation to the interbank transfers. That's the first thing. The second issue, and this has been globally, the second issue has been that the report of IBIS shows that 75% of global transactions are over-the-counter derivatives. So in essence, the most popular derivative in South Africa, by the way, is the JIBAR, which is around 3 months, which we call it normally hot money, right? And normally, really, that's not very good, by the way, from an economic investment perspective, but that's a conversation for another day, because it's hot money. People bring in money within 3 months, they withdraw out, and the economy would have not benefited anything. As I said, that's a conversation for another day. But I think the third issue here is that we must talk about what's the objective of introducing this new transfer rate. The first, it addresses three things. The first thing that it addresses efficacy, it addresses issues around appropriateness, it addresses issues around integrity. You know that the issue around integrity in terms of the financial market is very important. So what then the Reserve Bank has actually done, it has done what we'd call, it introduced this, by the way, in 2022 to really observe the reaction of the market, but that was backed by an open consultation process, which really sought to make it sure that all the people who are involved in what you call trade frequency financial capital markets, but also investors, right? And potential investors, but as well as public policy, that they're actually consulted about what this Zaronia actually seeks to achieve. So it seeks to achieve several things. I think the first issue that it seeks to achieve is market integrity and functioning. The second one is pricing right. The third one, it's around verification of contracts, and the other one, it's around ensuring that monetary policy and financial stability objectives. But the most important one, by the way, is correct pricing. Now, you would know that part of the reason why the interbank irregularities were picked up was that part of it was that there was an issue with the correct pricing within the market. So the intention is to make it sure that there are minimal market disruption. In fact, as I was saying, that the Reserve Bank had introduced this in 2022, and they've done what is called market observation to particularly see the market reaction. So by the time the announcement was made, actually in April this year, was that already the market has actually kind of like been given signals. There's been a preparation for it. So in essence, it means that the market is actually quite ready. So we've not seen any form of disruption since the Zaronia transaction have actually been introduced.
All right, thank you so much for answering my first question, which I asked, and the second one, which I haven't asked, but that's fine. Now, the next point of implementation, as we know, is derivatives market. Tell us a little about, give us an overview of the derivatives market and why you think the Reserve Bank chose this particular market for implementation at this point in time.
I think what the Reserve Bank is actually following is the whole restructuring within the financial markets. So I think different countries have really been following this. So you would know, for example, that we've seen, even from a banking perspective, new regulation around the capital reserve requirements. And this is the sector that has really not been partly been paid attention to, particularly with the introduction of cryptocurrency. So I do think that every country is trying its best to make it sure that it's not vulnerable, but also there are less errors, but fundamentally that data gets tested well, that's what in the Zaronia context has actually really happened. So in essence, because also the derivative market is actually a very volatile market. You had the point I was making earlier that one of the derivatives that is quite popular in South Africa around the over-the-counter sales derivative, it's the JIBAR, which is actually 3 months. That's quite volatile. So we have 3 months, we have 6 months, we have 9 months, and then we have 12 months. And there's several of those. So what South African government is actually, central bank is doing is that it's actually staggering the changes or the reforms that it's introducing within this market. In that now it's introducing this first Zanera, there's going to be the next forms of other. It's going to, for example, it's going to do away with other derivatives. For example, the derivatives called Sanex and with the other two derivatives. So they're actually, Zanera is actually going to be now the main reference rate that is actually going to be used going forward.
All right, we see that you and even the central bank anticipates a smooth transition for derivatives market. Do you see any potential challenges or disruptions that this shift to Zaronia might cause in the short term?
I think firstly, I must applaud the central bank is that they've tested the robustness of this area. And I think to date, they've not seen, there are no signals. I mean, they've not indicated any signals of market shocks, for example, that would have been driven by the new, the introduction of Zaronia. That's the first thing. But I think the second thing, we know in economic theory that there are always going to be what we call lags, right? So where, for instance, you find that you actually implement other interventions, and then there's going to be what we call a lag in terms of the market reaction. And I think the strategy of introducing this much more earlier in 2022, in 2024 now, test the market, interface with the various players of the market, private sector representative investors, risk advisory houses, media, economists, and financial market specialists. So it had kind of really couched and in some way manage any potential external shock that will arise as a result of this introduction. So, and I think that that's really, they've shown what I would call prudent leadership, because then in essence, it means that they are going into the market with actually a new reference rate that is actually going to be, that enjoys integrity, but also that is shown robustness and functioning in the market.
All right, just before I let you go, I'd like to get your thoughts on this. I mean, the central bank is saying that Zaronia will be rolled out to cash markets next year. That's 2025, while JIBAR, of course, will cease to exist in 2026. Let me get your thoughts on this.
No, I think this is part of their staggering approach, right? In fact, it's along the lines of the point you were asking earlier around whether there will be any market shocks associated with this introduction. So the staggering approach and the fact that they give market signals around their rollout process, the intention is to actually give signals, right, to those who are actually trading in the different types of derivatives in South Africa, that actually it will be rolled out in the next 2 to 3 months. So I think for me, that's actually really excellent. Amongst those, by the way, is that it will really be linked to alignment, global alignment, but also improved efficacy, and as well as it will be linked with the monetary policy and financial stability of what the Zaronia seeks to achieve, meaning that really we're not expecting any forms of interruptions going forward.
All right, so in less than 30 seconds, I see you're saying that this is a better reference rate and comparable to best practices all over the world. In less than 30 seconds, let's close on that.
Well, remember, every time you introduce any reforms, you would have actually consulted, and this is the feedback that the central bank has actually been has received, that actually this intervention as part of its reform is actually exceptional. And I do think that the real test, and I speak here now as a heterodox economist, that the real test now it's whether in fact this type of a reference rate will it actually be able to take up other over-the-counter derivatives beyond 3 months, 6 months, 12 months, and 14 months, because actually the real benefit for an economy like South Africa that is really growing at 6.06% is that it's when actually the traders take up the long-term to the medium to long-term derivatives, which are sitting between 6 months to 12 months and even sometimes 24 months, because then that actually the economy can actually benefit from those type of transactions. But short-term transactions by design are actually have absolutely no minimal value to the economy, but the value is actually derived by those who are actually trading within the financial markets.
Thank you so much, Phelisa Nkomo, economist, for sharing your thoughts with us today.